Well, I think valuations in the stock market generally are warped beyond
Hmm.
recognition. We've never seen these kind of multiples to earnings and cash flow that we're seeing today. And
Hmm.
that's just because of all of the monetary easing, quantitative easing that's been introduced in the market. So I kind of chuckle when I hear that they're tapering. Yeah, they're buying less, but they're still buying. They're still expanding money supply exponentially. They're just doing it at a slightly lower pace. But make no mistake about it, we've strapped on so much debt at the government level, not just in the United States, but globally across the industrialized world. There's no hope of ever finding a fiscally responsible way to repay that debt. They're going to have to print their way out of debt. They're going to have to inflate that debt away. So inflation is here to stay. Expanding money supply is here to stay, maybe at a slightly lower rate, but it will go up.
Everybody, this is Rob Keynes with 𝙂𝙊𝙇𝙀𝙍. I have a very special guest on today. It is David Garofalo, the CEO, President, Chairman, and Director of Gold Royalty Corporation. We profiled this company on the channel for you guys, and we're excited to have him on to explain a little bit more about how the company's been doing and what we should look forward to in 2022. How are you doing today, David?
I'm well, thanks, Robert. Thanks for having me on.
Yeah, thank you so much for joining us. We appreciate it. I wanted to start off with the gold and silver market and how they're doing. We had some exciting news about this time last year in silver, specifically with the silver squeeze movement, and both metals did pretty well last year. They seem to be doing okay this year, not at the top of their ranges. What is your outlook from like a macro perspective on what you expect to see in the precious metals for this year?
Well, I'll bottom line it for you. I think gold at 3,000, silver over $100 an ounce in this
Okay.
cycle. And I would say even this year, it's a distinct possibility because of the inflationary cycle we're experiencing. And the headline numbers are clearly at 40-year highs, 7+%. But the reality is if you're putting food in your stomach, fuel in your car, or a roof over your head, it's not 7%. It's far in excess of that. We're deep into double-digit territory in inflation, not unlike what we saw in the 70s and early 80s. And even as interest rates were going up, gold and silver galloped back then because it takes a long time for the real interest rate cycle to turn around. And so even as nominal rates go up a quarter point here, a quarter point there, inflation's been unleashed, it's accelerating, and we're going to have real negative rates and continue to have real negative rates deeper into negative territory for the foreseeable future. And that's hugely constructive for the one currency you can't print, gold, and by proxy, silver.
Yeah, I agree with you. And it was interesting news. The Fed's been hinting that they would reduce their asset purchases, taper as it's called. And they're the buyer of treasuries at this point, or at least the leading marginal buyer. They talked about that. They talked about raising rates. The Fed actually does reverse course of their QE program since the last financial crisis, about 12 years now. How do you think that affects gold and silver? Do you think that's positive for gold and silver?
Well, look, I think if you go back to the last inflationary cycle we had of any significance, which was the late 70s, Paul Volcker came in and ran the Federal Reserve starting in 1979, and he was an inflation hawk and started to ratchet up interest rates. But it took a long time for inflation to reverse its upward trajectory. And even as nominal rates were going up, inflation was still increasing and real rates were continuing to decline. And so I see a repeat of that phenomenon. We'll have several years of a run in gold and silver prices as a result of real rates continuing to go decidedly into negative territory. So it almost doesn't matter what they do in the short term because it'll be nominal, it'll be incremental, it'll be tentative. And frankly, there's nobody at the Federal Reserve today that remotely resembles Paul Volcker on inflation.
I agree with you. I think Powell probably could be considered a hawk, but that's relative to, the expansionary Fed presence we've had lately. And he tried that. I think we tried that fourth quarter of 2018. We had that 20% stock market correction here in the US. So I'm hesitant to say that if the Fed really goes aggressive, like they've said, that we won't have another market correction. And of course, I think that would change the narrative quite a bit. Do you think that people have already priced in what the Fed has said they're going to do, or do you think we're going to see big effects in the bond and stock markets if they actually do what they say they're going to do?
Well, I think valuations in the stock market generally are warped beyond recognition. We've never seen these kind of multiples to earnings and cash flow that we're seeing today, and that's just because of all of the monetary easing, quantitative easing that's been introduced in the market. So I kind of chuckle when I hear that they're tapering. Yeah, they're buying less, but they're still buying. They're still expanding money supply exponentially. It's just doing it at a slightly lower pace. But make no mistake about it, We've strapped on so much debt at the government level, not just in the United States, but globally across the industrialized world. There's no hope of ever finding a fiscally responsible way to repay that debt. They're going to have to print their way out of debt. They're going to have to inflate that debt away. So inflation is here to stay. Expanding money supply is here to stay, maybe at a slightly lower rate, but it will go up.
Yeah, it was interesting. I was reading a story on China today about their property issues. Of course, we know about Evergrande and the problems that they've had in an overvalued property development market. And I think that's a result of our expansionary policy with the dollar and also theirs with the yuan as well. There's new news that came out today that essentially they have the amount of open apartments across their country that would equal 27 New York City's total population. So they have this massive amount of unused apartment space. And it just seems, David, like there's so much underlying the general economy that's not healthy right now, that a lot of people don't know about, beyond just the Fed policies. You know, at some point, does this reverse course? Do all the economic issues that we have eventually reverse course and people flock to gold and silver at some point like they have in the past?
Yeah, and what you're speaking to is all of the excesses that have been introduced into the system, really going back to the credit crisis a dozen years ago, when there was a global coordinated effort by central banks around the world to print money, to reflate the economy, because we were on the precipice of our financial systems collapsing. So they did whatever they could, but they didn't stop. It's continued unabated for the last dozen years or so. And it seems to me that central banks pay more attention to the level of the stock market than they do to inflation, which is really what their license is. Its license is to tame inflation, keep it under control, keep pricing in control. But that hasn't been a focus of the Federal Reserve or frankly, any central bank globally in the last dozen years or so.
Yeah. You know, I came about this about 12 years ago. I was working for Ernst & Young. I was actually doing a project for Morgan Stanley. We were looking at the property market, and it really, back then, we had massive problems. And it kind of woke me up, and I started researching monetary history. And that's where I came upon gold and silver and kind of focused, you know, our channel on, because I think it's an opportunity for people to hedge against risk. And I see a lot of risk in the system right now. Of course, we've been talking about the risks. An interesting aspect of gold and silver is not just the bullion, it's leveraging your investments on the bullion and getting into the mining space, and in particular, the royalty space, because David, that gives you the ability to capitalize on value in the system. And I think if you look at the GDX and the HUI right now, the mining stocks are completely undervalued, maybe the most they've been undervalued in the last 30 or 40 years when I look at them in comparison to gold and silver. What type of opportunity does that provide investors who are, you know, looking for gold and silver leverage? You know, when this cycle changes, are they going to do really well in the mining stocks, do you think?
Well, I think you have to be selective. And you know, if you believe in gold as an asset class, which I do, and I know you do, there's several ways to play it. Obviously, you can buy the physical or the ETF that's physically backed, and that's the same as buying physical. But of course, there's storage costs associated with that. And it doesn't grow, but it protects your assets. Clearly, when treasuries are yielding -8, -9, 10%, inflation is so insidious, it eats your capital every day. It just sort of you know, there's no opportunity cost of owning gold, and it protects your assets, protects your capital. So that's one way to play it. There's nothing wrong with having physical gold in your portfolio. I think it makes a lot of sense. But you're talking about leverage the gold price. How do you leverage that increase in the gold price? And yes, one way to play that historically has been mining equities. Typically, their profitability, their margins should expand by a larger percentage than the gold price does if their costs remain stable. The only concern I have in mining equities and the producers right now is the costs are actually quite dynamic right now, given the backdrop of inflation in the general economy, and also because there's been significant underinvestment in exploration and development over the last half a dozen years, which is translated into a 40% decline in gold reserves and declining production profiles, which is why there's so much M&A activity right now. If you're not finding it in the ground, you have to buy it. But I think, you know, if you look at what happened 10 years ago as we came out of the credit crisis, that's instructive, because I think it's what's going to happen today. Gold went up 140% coming out of the credit crisis. The gold equities actually went up about 66%. They underperformed the commodity because at the time they were investing in new mine production, and we saw input cost inflation that eroded the margins and undermined the leverage proposition. It was the streaming and royalty companies in that point of the cycle did extremely well. They were up 350%. So they more than doubled the performance of the underlying commodity, because royalty and streaming companies provide that top line exposure. You're getting a percentage of the revenue, but you're not getting any exposure to the underlying costs of the mine site because it's just top line exposure. And that's the beauty of this model at this point in the cycle in an inflationary environment, which the mine operators, unfortunately, are not immune from.
And David, talk about the advantage of Gold Royalty Corp in particular. You guys have a little bit different take on how you've entered the space. And I really want to get your input as to what separates you from some of the other participants.
Well, certainly, I would say the diversity of our portfolio, the organic growth that we have. We started with an IPO 9 months ago when we raised $90 million on the NYSE with only 17 royalties, and they were all development stage. But we got a healthy currency. We went out and used it, and this is a sector that's ripe for consolidation. There is 3 large cap players in the space: Franco-Nevada, Wheaton Precious Metals, and Royal Gold. And then there is a proliferation of smaller cap royalty players who frankly can't grow because they can't access capital. They're too small, they're illiquid. And we saw an opportunity to consolidate the space. And so over the course of the last 9 months, we've absorbed 3 other companies, peer companies, 𝙂𝙊𝙇𝙿, Golden Valley, and Abitibi, and grown our royalty portfolio from 17 at the outset to 191 royalties today. 6 in production, so we have a healthy cash flow profile. In fact, we introduced a dividend last week. We're paying just under 1% yield, which we think we can grow because we also have 7, in addition to 6 in production, we have 7 in construction, which represent a meaningful cash flow growth. In fact, we think the best compounded average growth rate in cash flow in the business over the next 3 to 5 years as a result of those projects in construction. Beyond that, we have 180 other royalties at every stage of the life cycle, from early stage exploration through feasibility, that represents organic growth for many, many years to come. And so that's the unique value proposition. And I would say the other qualitative aspect of our business is we're populated with people that have actually operated and built mines. I came from an operating and mine development background, 32 years in the business, built 15 mines in my various roles. And operated countless more. And I'm not the only one. Within my management board, collectively, we have over 400 years of experience building and operating mines, which gives us a unique perspective, understanding the risks inherent in these royalty opportunities, but also, given the seniority of our team, it gives us access to virtually anybody in the mining business as we look for new royalty opportunities.
Yeah, and one I'm particularly interested in your acquisitions is Elemental Royalties, because when I talked to the management last year, they really had a different model. They were going after producing companies and wanted to fill their portfolio with those, and were pretty picky. So you had that cash flow and you had that immediate return. Was that your interest in Elemental Royalties, or why did you guys really target them?
Yeah, look, as I said, we completed 𝙂𝙊𝙇𝙿, Golden Valley, and Abitibi, and Elemental is a good fit. And anybody watching this, I encourage you to look at our filings on that offer. That offer was mailed to Elemental shareholders a couple of weeks ago. So I'd say go through the filings and make sure you educate yourself on why we think it's compelling both for Gold Royalty shareholders and Elemental shareholders. But look, it's a good strategic fit. They're in another tier 1 jurisdiction. 75% of our royalty base by value is in Nevada and Quebec, the top 2 jurisdictions in the world, as rated by the Fraser Institute here in Canada for mineral potential, low political risk, and low regulatory risk. Best gold districts in the world. They have a significant principal asset, Elemental does, in Karlawinda in Australia. And so it adds another tier 1 jurisdiction into our portfolio, helps them diversify their portfolio into tier 1 jurisdictions in the Americas, creates a much bigger, more liquid platform. We trade $3 to $5 million a day of stock. And so that provides more liquidity, more access to capital. And certainly we've been able to demonstrate we can access capital readily, whether it's in the equity markets, or more recently, we announced a $25 million line of credit with the Bank of Montreal on extremely attractive terms, 3 to 4% debt. So we have access to capital. We have a balance sheet, excuse me, with $40 million in cash and no debt. And so we have the financial capacity to grow the business and access capital. And on a combined basis, we think that makes a very compelling proposition for both sets of shareholders.
Yeah, and I think from the shareholder perspective, you're adding the dividend in. Now, dividends are fairly rare in the gold and silver space. You don't see it as much as you see in like telecom or utilities or some of these other sectors. Why did you guys decide to do the dividend program?
Well, we've grown our cash flow profile so quickly. We've been delighted about how quickly we've done that, much faster than our expectations when we IPO'd. And look, what we're building is a collection of annuities. We're taking annuities on these mines. We should share those annuities with our shareholders. I mean, shareholders are looking for capital returns, but income returns as well. So it certainly broadens the appeal of the investor universe, allows us to access more capital because we have a broader pool of investors to draw capital from.
And what should investors expect the next quarter? I know you guys have done a lot lately to really build your portfolio. You're in that building mode. Are you going to continue to be in building mode, or what is your focus going to be, say, the next 3 to 4 months?
Well, look, we'll continue to grow our business. I mean, the name of the game is, in the royalty business, you're a financial institution. You're there to provide capital to explorers and developers to build mine. And as I said, because of the significant underinvestment in mine development over the last half a dozen years or so, there's going to be a flood of capital going into new mine development. And we want to provide capital to those developers, be a provider of capital of focus for those developers, priorities, so that we can help them build their mines on a much more cost-effective basis than they could by, say, accessing the equity markets, where the cost of capital tends to be considerably higher.
Yeah, that's very interesting you bring that up. It seems as though since 2011, the last time gold hit its cyclical high, the investment in the mining space has been down, follow several investment indices, especially in the junior miners. The investment into juniors, explorers really is not where it was 10 years ago. Doesn't that create a situation, David, where we're looking at potential shortages? I know we're in a shortage situation with silver because it's reported by the Silver Institute. But Crescat Capital has this chart out about gold going into a deficit about 2027. It's called the supply cliff, where proven and probable ounces fall off. When does that come home to roost in this sector, and how do you think that's going to affect the valuations of companies like yours?
No, it's an excellent point. In fact, I think it has come to roost. As I said, there's been a steady decline in reserves over the last half a dozen years. We're down 40% from peak gold reserves across the producing community. And that downward trajectory is unlikely to reverse for at least a decade, because access to capital for the junior explorers who do all the grassroots, the producers don't, it's the juniors that do it, has been selective at best. They have not been able to consistently attract capital, access capital in the traditional equity capital markets in order to conduct those exploration programs. That's why you've seen an acceleration in M&A among the producers like Agnico and Kirkland Lake recently, which was a mega merger. You saw Kinross pick up Great Bear. You're going to see Pretium got taken over by Newcrest. As I said, if they can't find it in the ground and the juniors aren't exploring to do that, then the producers, out of existential necessity, need to buy other producers in order to maintain their production profiles and reserve bases. You're going to see a continued acceleration in that, because there hasn't been a meaningful amount of capital invested in grassroots exploration for at least half a dozen years. And even if something major were found tomorrow, we wouldn't get the benefit of it in the industry for at least a decade, because the typical lead time from discovery to first production is 15 to 20 years.
Yeah, that's true. That's a good point to make. So definitely, I think opportunities for people in this space next 5 to 6 years. I think historical undervaluations of the mining, equities, and also the lack of the minerals causing everybody to flock. And at some point, the generalists are going to come back. They're going to see the opportunity. They're going to get tired of trading Tesla at 1,000 times earnings, and they say, here's a value investment. And the Warren Buffett, Peter Lynch value investment is going to come back. And I think that's going to invest in the mining sector, because it might be the most undervalued sector in the market at the moment.
Yeah, you know what? And when sentiment turns, Robert, it turns on a dime. And these things don't go up in a nice steady line. What happens is it's violent upwards movements of both the commodity price and the equities. You're going to see a reflation of the equity valuations as the commodity starts to violently move upwards. It's not unlike what we saw in copper in the last year. Copper was down in the dumps a year and a half ago. Now it's at all-time highs. When sentiment turned, it turned quickly, violently, and capital got allocated when that sentiment turned in a very meaningful way. That's
a good point. I think copper, zinc, even lead to some extent, have reached some highs. They're all doing very well. I do see that come into the precious metals as well. And that's a good sign for investors going forward. I think now is the time you want to get in if you're building your portfolio of investments in this space. And definitely, I've always loved the royalty companies. I always focus on them because you're getting access to those ounces in the ground at much cheaper than you would with less risk than if you're going to the miner. So definitely a way to diversify your portfolio. David, if people are interested in your company, tell us how they can get more information.
Well, it's easy to remember, goldroyalty.com, and we're GROY on the New York Stock Exchange.
Fantastic. Thank you, David, so much for joining the program. We appreciate having you on today.
Thank you, Robert.
Thank you guys so much for watching today's video. We appreciate it. Please remember to like, subscribe, and share, and hit that notification button so you get those notifications when new content comes out.